Your IQ above 100 and 30 makes you more likely to lose money in the stock market, not less. Counterintuitive, right? You'd think smarter people make better financial decisions. The data says the opposite. And here's the thing that really gets me. These doctors and engineers and tech executives who can solve complex problems that would make your head spin are often the same people panic selling their investments during a market crash, or keeping $200,000 in a savings account earning 0.5% interest because they're terrified of the stock market. So, what's going on here? How can someone be so smart in one area of life and so completely irrational when it comes to money? My name is Joe, and I spend way too much time thinking about money, human psychology, and why otherwise intelligent people consistently make terrible financial decisions despite having all the information they need to make good ones. If you've ever wondered why your smartest friends sometimes do the dumbest things with their money, make sure to hit that subscribe button and give this video a thumbs up if it helps explain this maddening mystery. Now, before we dive into the psychology of why smart people make terrible money decisions, let me paint you a picture of what we're actually dealing with here. Morgan Housel, in his book, The Psychology of Money, starts with a fundamental premise that challenges everything we think we know about personal finance. He argues that financial success is not about knowledge, intelligence, or mathematical ability, it's about behavior, and behavior is notoriously difficult to teach, even to smart people. Think about it this way. In most areas of life, being smarter gives you an advantage. If you're a brilliant engineer, you can design better bridges. If you're a gifted doctor, you can diagnose diseases more accurately. If you're a talented programmer, you can write more efficient code. Intelligence is a genuine superpower in technical fields where there are right and wrong answers. But here's where it gets really interesting. Money doesn't work like engineering or medicine or computer science. There are no right answers in personal finance. There are only decisions that work for your specific psychology, your specific circumstances, and your specific goals. A financial strategy that makes perfect sense for one person might be completely disastrous for another, even if they have identical incomes, identical investment opportunities. The difference is their psychology. Housel tells a story about two people that perfectly illustrates this point. One is Ronald Reed, a janitor and gas station attendant who never made more than $20,000 a year, but amassed an $8 million fortune by consistently saving and investing in blue chip stocks over his lifetime. The other is Richard Fusconi, a Harvard MBA and Merrill Lynch executive who earned millions annually but went bankrupt in his 50s due to excessive borrowing and lavish spending. On paper, Fusconi should have been the financial success story. He had the elite education, the high-paying career, and the professional expertise. But Reed understood something that Fusconi didn't. He understood his own psychology and designed a financial strategy that worked with it, not against it. This is the central insight of the psychology of money. Financial success isn't about being the smartest person in the room. It's about understanding yourself well enough to make decisions you can actually stick with when things get difficult. The most sophisticated investment strategy in the world is useless if you panic and abandon it the first time the market drops 20%. The most mathematically optimal savings rate is meaningless if it makes you so miserable you give up after 3 months. But here's something that most people don't realize about financial behavior. Your financial decisions are driven by experiences and emotions that have nothing to do with math. Someone who grew up during the Great Depression will have a completely different relationship with money than someone who grew up during the booming 90s, even if they have identical educations and identical IQs. Someone who watched their parents lose their house to foreclosure will make different choices than someone whose parents always seemed financially secure. These experiences shape our financial psychology in ways that pure logic and education can't easily override. Housel emphasizes that personal finance is deeply personal because it involves your unique history, your unique worldview, and your unique goals. Two people can look at the exact same set of financial facts and reach completely different conclusions, and both can be right for their specific situations. This is why financial advice that works for one person often fails for another, and why smart people often ignore good advice that doesn't fit their psychological makeup. But wait, here's the part that will blow your mind. There's a specific phenomenon that Housel identifies that explains why even experts make terrible financial predictions. He calls it the seduction of pessimism, and it's one of the most powerful forces in financial markets. Here's how it works. Optimism sounds like a sales pitch. It sounds naive, unsophisticated, and blindly hopeful. Pessimism sounds like someone trying to help you. It sounds smart, cautious, and protective. But here's the crazy part: pessimism often gets more attention than optimism because it triggers our survival instincts. When someone warns you about impending doom, your brain pays attention because avoiding threats was more important for survival than pursuing opportunities throughout human history. This is why doomsday predictions get more media coverage than positive forecasts. It's why bearish investors are often portrayed as sophisticated realists, while bullish investors are dismissed as foolish optimists. But history shows that over long time periods, optimism is actually the more rational position. Markets have consistently grown over decades despite countless crises, recessions, and catastrophes. The people who stayed invested through the downturns were rewarded, while the people who panicked and sold at the bottom locked in their losses. Smart people often make terrible financial decisions because they think pessimism equals intelligence. They believe that worrying about money, constantly preparing for the worst, and assuming everything will crash is the prudent approach. But this mindset often leads to paralysis, missed opportunities, and terrible investment timing. The person who keeps all their money in cash because they're afraid of market volatility is making a terrible decision, even though it feels safe. They're guaranteeing that inflation will erode their purchasing power while missing out on the long-term growth that builds wealth. But here's where it gets really interesting. Like, there's another psychological trap that even highly educated people fall into constantly. Housel calls it the maniac in the mirror problem. We all know someone who bought a stock that went up 500%, or sold a house at the perfect time, or started a business that became wildly successful. We see these success stories and think, if they could do it, why can't I? But we rarely see the full picture of how many failures preceded that success, how much luck was involved, or how different their circumstances were from ours. When we look at ourselves, we see all the doubts, fears, and uncertainties that we hide from the world. When we look at successful people, we see only their highlight reels. This asymmetry leads us to take risks we shouldn't take, pursue strategies that don't fit our personalities, and compare our behind-the-scenes struggles to other people's carefully curated success stories. Smart people are particularly vulnerable to this trap because they believe their intelligence can overcome any obstacle. They think that if someone else figured out how to day trade successfully, or pick winning stocks, or time the market, they can learn to do it too. What they don't realize is that the people who succeed at these difficult endeavors often have specific psychological traits, risk tolerances, or sheer luck that can't be replicated through education alone. Housel tells another story that illustrates this perfectly. He describes two investors with completely different approaches. One studies finance obsessively, reads every economic report, watches the markets constantly, and trades frequently based on his analysis. The other knows almost nothing about investing, contributes to a simple index fund every month, and never checks his balance. Over a 20-year period, the second investor almost always outperforms the first, not because he knows more, but because he doesn't get in his own way. The intelligent investor's knowledge becomes a liability when it leads to overconfidence, excessive trading, and emotional decision making. The less knowledgeable investor succeeds because he sticks to a simple strategy that matches his temperament. This is deeply counterintuitive to smart people because they've spent their entire lives believing that more knowledge leads to better outcomes. But in investing, knowing too much can actually hurt you because it makes you think you can predict the future or time the market or outsmart other smart people. The reality is that no one can consistently predict short-term market movements, not even professionals with advanced degrees and sophisticated models. But here's something that might surprise you. The biggest financial mistakes often aren't caused by lack of knowledge or intelligence. They're caused by lack of self-awareness. Smart people often know exactly what they should do. They've read the books, studied the research, and understand the mathematics of compound interest and diversification. But knowing what to do and actually doing it are completely different things. Hausa emphasizes that financial success requires emotional intelligence more than intellectual intelligence. You need to understand your own triggers, biases, and psychological weaknesses. You need to design a financial plan that accounts for the fact that you will panic during market crashes, that you will be tempted to spend impulsively, that you will compare yourself to others and feel inadequate. A plan that assumes you'll always behave rationally is a plan that's doomed to fail. The people who build real wealth aren't necessarily the smartest or the most knowledgeable. They're the people who found a strategy that works with their specific psychology and stuck with it through good times and bad. They didn't try to optimize for maximum returns, they optimized for maximum consistency. They chose boring, simple approaches that they could maintain for decades rather than sophisticated strategies that required perfect discipline and timing. But wait, there's another layer to this that most people completely miss. Housel talks about the concept of tails, which explains why financial outcomes are so unpredictable and why smart people often get blindsided. In most fields, outcomes follow a normal distribution. Average performance is common, and extreme outcomes are rare. But in finance, extreme outcomes called tails drive most of the results. A small number of investments, decisions, or events create the majority of gains or losses. This means that you can make good decisions consistently for years and still have terrible outcomes if you get unlucky. Conversely, you can make mediocre decisions and have great outcomes if you happen to be exposed to positive tail events. Smart people hate this because it feels unfair and random. They want to believe that their intelligence and work will guarantee good results. But financial markets don't care how smart you are. They care about unpredictable factors that no one can control. This is why even the most sophisticated investors often underperform simple index funds. They're trying to be smart in a domain where being smart isn't enough. Housel argues that the most important skill in finance is knowing when you have an edge and when you don't. Smart people often think they have an edge in everything because they've succeeded in other areas of life. But investing is different. The market is filled with brilliant people competing against each other. The odds that you're smarter than all of them, or have better information, or can predict the future better are incredibly low. Accepting this reality is humbling, but it's also liberating. It frees you from the pressure to outsmart everyone else and allows you to focus on what actually matters: controlling your behavior, managing your psychology, and staying in the game long enough for compounding to work its magic. But here's where it gets really interesting. There's a specific type of financial mistake that smart people make more than anyone else. Housel calls it the tendency to optimize for peak performance rather than sustainable performance. Smart people want to find the absolute best investment strategy, the perfect asset allocation, the optimal savings rate. They analyze historical data, run complex calculations, and backtest different scenarios to find the mathematically superior approach. But this optimization often leads to fragility. The strategy that maximizes returns on paper often requires precision, discipline, and emotional control that real humans don't possess. When market conditions change or personal circumstances shift, the optimized strategy falls apart. The person who chose a good enough strategy that they can actually stick with ends up outperforming the person who chose the theoretically optimal strategy that they abandoned at the first sign of trouble. This is why simple, boring financial strategies often beat complex, sophisticated ones. They're robust, they work in different market conditions, they don't require perfect execution, they account for the fact that you're human and will sometimes make mistakes or have emotions. Smart people hate this because it feels like settling for mediocrity. But in finance, mediocrity that you can sustain beats excellence that you can't maintain. But here's something that most people don't realize about the psychology of money. Your relationship with money isn't just shaped by your own experiences. It's shaped by the experiences of your parents, your grandparents, and even generations you never met. Someone whose grandparents lost everything in the Great Depression will have different instincts than someone whose family has always been financially comfortable, even if they have identical educations and identical current circumstances. These inherited psychological patterns influence our decisions in ways we don't even realize. We might think we're making rational choices based on current facts, but we're often just replaying scripts written decades ago by people facing completely different economic realities. Housel emphasizes that understanding your financial history is crucial because it helps you recognize which of your instincts are serving you and which are holding you back. Maybe your fear of debt is protecting you from predatory loans, or maybe it's preventing you from investing in yourself through education or entrepreneurship. Maybe your desire for financial security is motivating you to save, or maybe it's paralyzing you with anxiety. The point isn't to eliminate these psychological patterns. They're part of who you are. The point is to recognize them and design your financial strategy accordingly. But wait, here's the part that will really blow your mind. Housel identifies a concept that explains why smart people often make terrible long-term financial decisions, even when they know better. He calls it the seduction of forecasting. We all want to believe that we can predict the future, that we can see what's coming and position ourselves accordingly. This desire is especially strong in smart people because they've succeeded by being able to anticipate problems and solve them proactively. But financial markets are inherently unpredictable in the short term. No one knows what will happen next year, next month, or even tomorrow. The people who claim they can predict market movements are either lying, deluded, or selling something. Smart people often fall for these predictions because they sound logical and sophisticated. The forecaster uses complex charts, economic data, and historical patterns to build a convincing case for why stocks will go up or down. It sounds intelligent and well researched. But the reality is that financial markets are driven by millions of unpredictable human decisions, unexpected events, and random factors that no model can capture. The most intelligent forecast is still just an educated guess, and often not even that. Housel argues that the solution to this problem isn't to become a better forecaster, it's to stop forecasting altogether. Instead of trying to predict the future, focus on preparing for multiple possible futures. Build a financial plan that works whether the market goes up or down. Save enough that you can weather bad times without panicking. Invest in a way that doesn't require you to know what happens next. This approach feels unsatisfying to smart people because it admits uncertainty rather than conquering it. But it's the only approach that actually works in a domain where certainty is impossible. But here's where it gets really interesting. Like there's a final psychological trap that ensnares even the brightest minds. Housel calls it the social comparison trap. Humans are inherently social creatures. We constantly compare ourselves to others to gauge our status and success. This was probably useful in small tribal communities where knowing your rank helped you navigate social dynamics. But in the modern world, where we're exposed to the carefully curated highlight reels of thousands of people through social media, social comparison becomes toxic. We're comparing our behind the scenes struggles to other people's public victories. We're measuring our financial progress against people who inherited wealth, got lucky, or are simply lying about their success. This comparison leads to terrible financial decisions. We buy things we can't afford to signal status. We take unnecessary risks to catch up with people who aren't even playing the same game. We feel inadequate about completely reasonable financial situations just because someone else appears to be doing better. Smart people are particularly vulnerable to this trap because they've spent their lives competing and winning. They're used to being at the top of their class, earning the highest scores, and achieving recognition. When they enter the financial world and realize there will always be someone richer, someone with a bigger house, someone who made a lucky investment that paid off spectacularly, it triggers deep insecurities. They start making decisions designed to prove their worth rather than serve their actual needs and goals. The person who buys a luxury car they can't afford to impress people they don't like is making a terrible financial decision. But they're also making a predictable psychological decision driven by the need for social validation. Smart people often think they're immune to this because they understand the concept of signaling and status games intellectually. But understanding something intellectually doesn't make you immune to it emotionally. Housel's solution to this problem is radical but effective. He suggests that the best financial strategy for most people is to become increasingly moderate in their spending and increasingly ambitious in their saving and investing. This sounds boring, and it is, but it works because it removes you from the status competition. When you're not trying to impress anyone with your spending, you free up enormous amounts of money to build real wealth. When you're not keeping up with the Joneses, you can focus on what actually makes you happy rather than what looks impressive. But here's the beautiful part about this approach. It creates a virtuous cycle. The less you spend on status symbols, the more you can save and invest. The more you save and invest, the more financial security you gain. The more financial security you gain, the less you care about status symbols. You become increasingly immune to the social comparison trap, while simultaneously building the wealth that would have allowed you to play the status game if you wanted to. Smart people often resist this advice because it feels like giving up or admitting defeat. They want to believe they can win the status game through intelligence and strategy. But the only way to win the status game is not to play. The people who build real wealth are often the ones who opt out of the competition entirely and focus on their own definition of success. So there you have it. The psychology of money reveals why smart people make terrible financial decisions despite having all the knowledge and information they need to succeed. It's not because they're stupid or uninformed. It's because money is fundamentally about behavior, emotions, and psychology, not just mathematics and logic. The people who succeed financially aren't necessarily the smartest or the most educated. They're the people who understand themselves well enough to design strategies that work with their psychology. They accept that they can't predict the future, so they prepare for multiple possibilities. They recognize that they're vulnerable to social comparison, so they opt out of status games. They know that they will panic during market crashes, so they create systems that don't require them to make rational decisions under stress. The most sophisticated financial strategy is worthless if you can't stick with it. The simplest strategy is incredibly powerful if you can maintain it for decades. Intelligence is a wonderful thing, but when it comes to money, emotional intelligence, self awareness, and consistency matter far more than IQ. If you haven't read The Psychology of Money, I can't recommend it highly enough. It's one of those rare books that will genuinely change how you think about wealth, success, and financial decision making. And more importantly, it might just help you avoid the mistakes that even the smartest people make when they forget that money is ultimately about psychology, not just math.